Hey everyone, in this video I go over the first chapter of our text, Financial Accounting 11th edition. In the first chapter, we go over the basic concepts and definitions in the accounting process. So we start our chapter by the definition of accounting. Accounting is a process, it's a systematic process of several activities and verbs basically on financial information. We start with identifying our financial information, our transactions, and then measuring, recording, classifying, summarizing, interpreting, and finally reporting our financial information. Of course, the order matters. We start with identifying and we end in reporting. But in this text, out of these 7 verbs, we mostly focus on identifying, recording, and reporting. So the accounting process is defined as the process of identifying, recording, and reporting financial information. But let's briefly talk about different areas in accounting. We do have financial accounting, we do have managerial accounting, tax accounting, auditing, other areas in accounting, for example, forensic accounting or accounting for non-profit firms. So financial accounting is the area of accounting that deals with external users, meaning those reports, if you remember the last verb, the last activity in the accounting process was reporting. Those reports are mostly of the interest of external users. Managerial accounting, on the other hand, it is the internal user who is interested in managerial accounting reports. Who are external, who are internal users? We will learn about them. But this course is financial accounting, right? So we really do not touch other areas of accounting in this class. We are focused on financial accounting. Why it is called financial accounting? Well, basically because we are dealing with 4 financial statements, including income statement, retained earnings statement, balance sheet, and cash flow statement. These 4 financial statements are the output of a financial accountant job. 5 groups of accounts. We do have 5 groups of accounts. The first one is asset, second one liability, third one equity, next revenues, and finally expenses. So we have several accounts inside the asset group, we have several accounts inside the liabilities, and so on and so forth. And we use these accounts inside each group to summarize and to categorize our transactions. In this chapter, we have 5 learning objectives. We start with different activities and different users related to accounting process. At this point, you have a basic understanding of different users. So we learned that we have internal users and external users. We'll talk about them again. In the second learning objective, we will talk briefly about ethics, principles, and assumptions of accounting. In the third one, we learn about accounting equation. This is an extremely important topic, accounting equation. It remains with you for the rest of the semester. And of course, we will define and learn about its components. To my understanding, the third learning objective is the most important learning objective of this chapter, which means you need to spend more time on this one compared to the other ones. In the fourth learning objective, we will talk about the different effects of transactions on our accounting equation. So In learning objective 3, we learned about accounting. We will learn about accounting equation. And in learning objective 4, we see how different transactions could affect our equation. And finally, in learning objective 5, we briefly go over our financial statements. We have 4 of them. Remember, income statement, retained earnings statement, balance sheet, and cash flow statement. Our goal in this class in financial accounting is to make sure that we are able to prepare financial statements. In this class, we really do not go over cash flow statement. You will learn about cash flow statements in your future classes. Okay, learning objective 1, identify activities and users related to accounting process. As we learn, accounting is a process of, based on this text, 3 activities or 3 verbs: identifying, recording, and reporting or communicating. So both are the same. You communicate your information, financial information, to the users, you report to them. I'm sure you have heard about the term bookkeeping. Bookkeeping is basically a subcategory of the recording process. Bookkeeping is not accounting. Accounting is a broader concept. Bookkeeping is just a subcategory among one of those activities in the accounting process. We basically just record, classify, and summarize our transactions as a bookkeeper. But accountants have different jobs, different tasks. As we learn, they need to identify the right transactions, they need to report or communicate their statements to their users, and they need to sometimes analyze and interpret the data, the information for the users. But who are those users? So we have 2 groups of users, internal users and external users. Internal users are all those departments, those people working inside the company, like marketing manager, like CFO, even a supervisor in HR, human resource department, could be interested in our reports. But we learned that it is managerial accounting concern to give information to internal users. In financial accounting, we are more concerned about our external users. Who are those users? For example, your investors, those who put their money into your business. Creditors, those who lend you money. They are also interested in your financial well-being. In learning objective 2, we'll talk about the building blocks of accounting and ethics, principles, and assumption. Something that I want you to focus on in this learning objective is Sarbanes-Oxley Act, or short SOX. It is commonly called SOX Act of 2002. SOX Act of 2002 is a piece of regulation enacted in year 2002 after several scandals done by big companies at that time. The idea was to make it more difficult for companies to behave unethically, to basically deceive their investors. So in 2002, SOX was enacted by Congress to make sure that companies are now more limited in terms of their ability to deceive investors. Our next topic is GAAP. It's spelled as GAAP, but we pronounce it GAAP. So GAAP is basically the holy book of accountants. Every rules, every standard, what to do, what not to do as an accountant is written inside that book. It is called GAAP, Generally Accepted Accounting Principles. People need to have information, right? There is a need for financial information. Investors need to know what's going on inside the company. Creditors, lenders need to know what's going on inside the company financially. So different users need different types of financial information. And in order to fulfill that need, accounting profession developed some standards to make sure that our reports are similar, they are comparable. Different firms have similar reports, mostly in terms of format. Those standards are called GAAP. But who issues GAAP? Who is responsible for issuing GAAP? These standards are issued by an organization called FASB. FASB, it is pronounced FASB. Financial Accounting Standards Board is a board below SEC, Securities and Exchange Commission, and above SEC is basically the US government. But there are some other bodies, some other organizations as well. For example, IASB. IASB is the same as FASB in the US, but they prepare international accounting standards. So there is not just one gap, there is not just one type of a standard. It depends on the country. Different countries may or may not have different standard accounting standards. Here in the US, we use US GAAP. Some other countries, mostly in the Europe, they use another kind of standards called IFRS, International Financial Reporting Standards. The next topic is about different types of businesses. We can categorize different firms, different companies based on their ownership structure. Who owns the company? How many people own the company? So based on the ownership structure, we can categorize firms into three groups. The first group is called sole proprietorship or simply proprietorship. The second one is partnership, and the last one is corporation. So proprietorship firms, they are owned by only one person. Small stores are a good example of proprietorship firms. The owner, him or herself, is often the same as the manager and the same person who operates inside the business, inside the store. The second one is partnership, when a company is owned by more than one person, two or more than two people. Most of the time, they are service type companies. The third one is corporation, when we have several owners and when there is something called shares of stock. Corporations are usually larger than the other forms in terms of size and in terms of their revenue, most of the time. But there are some interesting differences between these three firms in addition to the number of owners. For example, in corporation, liability of owners is limited, but for partnership and sole proprietorship firms, we do have unlimited liabilities. What does that mean? It means if the company goes bankrupt, then in corporations, owners' responsibility is limited. They don't need to be worried about paying all debts to the lenders out of their own money, out of their own pocket. Their liability is limited to their investment amount. But if we have a partnership firm and we go bankrupt, then lenders can come after our own personal properties. They can come and sell our house, sell our car. They can have access to our bank accounts. We have basically unlimited responsibility, liability to pay off all our debts. In learning objective 3, we learn what the accounting equation is. So the accounting equation is a simple formula, as you can see it here. It reads total assets in a company equals to total liabilities plus stockholders' equity. So what are these items? What are assets? What are our liabilities? That's what we are about to learn. Assets are everything that company owns. Okay, they are resources that the company owns. Why do we call them resources? Because we can use our assets to make money, to provide future benefits. So there should be two conditions together. Examples are like cash, equipment, computers, projectors, printers. These are things that you own and you can use them to make money in your business. These are called assets. Another example, like buildings, like land, like vehicles. These are all examples of assets. Inventory, another one. So that was asset. Next is liability. Liabilities are claims against assets. What does that mean? It means lenders, creditors, they can claim against what we have. They can come and take our money because they have lent us, right? Their money is in our hands, so they have the right to claim against our assets. Those who lend us, creditors, they will be reported under liabilities. Liability is the money that we owe. So basically assets, what we own, liabilities, what we owe to other people and companies. Examples are like accounts payable. We will learn what accounts payable are. Or for example, salaries payable. Basically, all the payable accounts are liabilities. We are liable to pay off these amounts. The third component of our accounting equation is called stockholders' equity. Equity is ownership claim, investors' claim on our assets. Our accounting equation was assets equal liabilities plus equities, right? It's here. It basically means lenders, creditors, as well as investors, both of them have the right against our assets. They can come and collect. They can come and take our money, take our car, take our building. They can claim against our assets. Examples of equities: common stock and retained earnings. In chapter 11, we go over the equity section. My friends, it is important to note that equity is just a number. Your investors put money into your business. That money goes to your bank account. It will be reported as an asset, but you just record that you received money in the form of equity. Okay, so the actual money will be recorded here as an asset, but under the right side of the equation, we just record that money was received and it was deposited in our bank account. Okay, so the actual money goes to the left side of the equation. The right side are just some records showing how this money is funded, is provided. As our investors invest in our company, our equity goes up. We record and we report that we have received money from our investors. It goes up. As our company makes money in its operation, It also increases our equity. We'll talk about that later. But what decreases the equity? Expenses decrease our equity as well as dividends. So, what are examples of revenues before we talk about expenses and dividends? Examples of revenue include like sales, fees, interest, rent as an owner. Your rent you collect is your revenue. As a manufacturer, as a seller, the money that you collect is your revenue. Dividends, it is an important term. Dividends are the distribution of cash or different types of assets to stockholders, meaning you may decide to take out some money out of your business and give it to your stockholders. It is called dividends. Remember, paying dividends is an optional decision. Companies may or may not decide to pay dividends. It is not a must. And the second important point about dividends is that dividend is not an expense. But what is an expense? So expenses are all those payments that are gone. They are consumed. They are used. All those costs that are gone, you cannot have them back. We call them expense. Examples like rent expense. As a renter, the money that you give to your landlord is your expense. As you paid to your owner, you cannot have it back. It is gone. Utilities expenses. My favorite example, the electricity you use, your water bill, your gas bill, they are all expenses. You have used them, you have consumed them. So you have to pay them and you cannot have that money back. It is not just like purchasing a laptop and return it tomorrow. So that's the difference. That's the major difference between expenses and assets. You can convert your assets to cash, but you cannot convert your expenses to cash. They are gone, they are consumed. In learning objective 4, we talk about the effects of different transactions on our accounting equation. What are transactions? Whatever you do in your company is a transaction. Okay. Whether it is an economic transaction or not, that's another story. What are economic transactions or economic events? Those events that involve money. If money is not involved, that transaction is not an economic event. These transactions could be external or could be done inside the company. As I told you, not all activities, not all events are financial transactions. And finally, every transaction, every economic transaction has a dual effect on the accounting equation. What does that mean? If this is our accounting equation again, if a transaction reduces our assets, there should be another effect somewhere. Maybe our liabilities are also reduced, or maybe our equity is also reduced, or even maybe we do have another increase within the asset group. There should be at least two effects on our accounting equation. Okay, the effects could be both on one side like this, or one effect could be on the left side of the equation, one effect could be on the right side of the equation. It all depends on the type of the transaction. In this class, Our major focus is to learn how different transactions affect our accounting equation. Take a look at this diagram. Some items are listed one after the other. Okay, as you can see, the first one is highlighted here. Analyze business transactions. This is what we are going to learn now, how to analyze business transactions. We are not worried about the other terms for now, but just take a quick look at the diagram. We are going to use it in the future a lot. So, what kind of events, what kind of activities should be considered as an economic transaction? So, for example, here we have three events. We purchase a computer, we discuss product design with a customer, and we pay our rent. Which one should be considered as an economic transaction? Is money involved? If yes, it means that the financial position is changed, is affected. What is financial position? Either our assets or our liabilities or our stockholders' equity. Okay, so a financial transaction changes our financial position, assets, liabilities, or equities. Therefore, when we purchase computer, of course, money is involved. Of course, accounting equation is involved. Therefore, we record it. When we pay rent, we are losing money. Money is involved. Equity is involved. Expenses are involved. Therefore, the equation is changed. Therefore, we record it. Discuss product design with customer. We are just discussing. There is no money involved. Therefore, we do not record this transaction. But accounting equation is not as simple as what we learned so far. That was the basic form of accounting equation. Assets equal liabilities plus equities. We can decompose equity into two components, common stock and retained earnings. Common stock is a certificate of ownership, is the money that investors put into our company, into the company, and own part of the company. Retained earnings is the money made inside the company, is the revenue that you collected and you retained, you kept it inside the company. You didn't spend it, you didn't distribute it to the investors as a dividend. Retained earnings, money which is kept inside the company, is made and kept inside the company, plus the money that investors put into the company, both together are called equity. We can even go further and take it to the next step and decompose it more by looking into the retained earning box here. Retained earning can be written as the money that you collected minus the money which is gone, is used, is consumed, minus dividends, the money that you distributed, you gave to the investors. So revenue minus expenses minus dividends, it is called retained earnings. I can rewrite this formula in an expanded form. It would be like assets, let me clear, assets equal liabilities plus, instead of equities, I want to write down their components, common stock plus retained earnings. Okay, I also can write down this retained earning using its components. So instead of retained earnings, I would write revenues minus expenses minus dividends. This is retained earnings. See how our accounting equation is expanded now? We use this formula in this course a lot, so keep that in mind. Due to the importance of this slide, call this the most important slide of this chapter. In every chapter, I highlight some slides just like this, and I would call them the most important slide of the chapter. You are expected to save or print out these slides and have them in front of your eyes all the time, so you will not forget about the information inside them. This slide is going to extremely help you doing your homework and learning the subject. So let's see an example. Let's see how a transaction can affect our accounting equation. Transaction 1, investment by stockholders. They decide to start a smartphone app development company that they incorporate as SoftBite on September the 1st. They invest $15,000 cash in the business. They invest. So this is the keyword you need to pay attention to. They invest $15,000 cash in the business in exchange for $15,000 of common stock. $15,000 of common stock. There was another important keyword here. In exchange. So they put their money into the company, $15,000, and in exchange for that, they receive common stock. What is common stock? Again, just a number, just a certificate, a piece of paper showing that, hey, you have put $15,000 in the company, you have the right to claim against our assets by that amount. So what happened here is that we received cash in our company, cash went up, and also we recorded that now some new people can claim against our assets. Equity is increased now. We do have new owners basically. How this transaction affects our accounting equation. So here, this is our accounting equation, assets, liabilities, equities. As you can see, assets, there are some components inside the asset group. I told you these are called groups of accounts. So here, cash is an account, equipment is an account, supplies is an account. They are all in the family of assets. So due to this transaction number 1, cash went up. We collected $15,000 cash in exchange of a record of common stock. Now we show that this $15,000 in our bank account is funded by common stock. Next, in the company, we purchase equipment for cash. What kind of equipment? Computer equipment for $7,000 in cash. How that would affect our transaction. Pause the video and think about it for a second. So here we have purchased an equipment, right? When we purchase things, we pay. So cash goes down. We lost our money, $7,000. We don't have it anymore. In exchange, we received a new piece of equipment. Let's see how it works in our accounting equation. So again, we are here. In the second transaction, the first line is just for the previous one. In the second transaction, we gave up our money. We paid in cash. We gave up our money. Cash went down. In exchange, we received a new computer. with a value of $7,000. As you can see, this transaction didn't affect the right side of our equation. Now you should be able to notice a pattern. Let's go ahead and do the third one, and we will talk about the pattern. So in transaction 3, purchase of supplies on credit. So this term is important. Let me go to the previous slide here. As you can see here, we purchased equipment for cash. Okay. But here we are purchasing something on credit. So these two are two different terms. When we purchase something for cash, we give up real money. Okay. But when it is on credit, or there's another term for that, on account, we do not pay right away. We purchase our product, whatever that thing is, but we promise to pay later. It is called on credit. The seller gives us credit. We don't use money, we don't use cash to purchase that thing. So here we are purchasing supplies on account. Basically, we promise to pay later. The amount is $1,600, some headsets and accessories. The seller allows the company to pay this bill in October. Okay, how this would affect our equation? Let's see. So we are not worried about 1 and 2. In line 3, transaction 3, we purchased some supplies. When we purchase things, that thing will be increased, will go up. But we didn't pay using our cash, so cash was not used. What was used then? We promised to pay. We went under liabilities. We promised to pay in the future. That is called accounts payable. So we record that we have to pay in the future $1,600. So the pattern I was talking about was the fact that every single transaction, as you see, let me clear the screen. As you can see, every single transaction keeps accounting equation in balance. If $15,000 go up, so this is our equal sign. If $15,000 go up on the left side, the same amount go up on the right side. If $7,000 decreases the left side of the equation, same amount increases the same side of the equation. So the total, the aggregated effect is 0. You are still in balance. If supplies goes up on the left, something else on the right should also go up. So when we see a transaction, remember our first term in accounting definition was to identify, right? When we identify a transaction and we start analyzing that transaction, we need to take into consideration 2 items. First, what components of our accounting equation is affected? Components are assets, liabilities, and equities. Which one is affected? It depends on the transaction, right? And then after identifying these groups of accounts, these components, what exact account is affected within each of these components? Is it cash inside the asset, or is it supplies inside the assets? Or maybe it is equipment inside the assets. So we need to do these 2 analysis, which one is affected. But regardless of different accounts and different account groups, different components, both sides of our equation must always be equal. Again, the seesaw should always stay in balance. In our last learning objective, we will talk about our financial statements. So we have, as we talked, we have 4 financial statements. We learn about them and we also briefly learn how to prepare those statements. Our financial statements, as you already know, are income statement, retained earnings statement, balance sheet, and a statement of cash flows. Of course, again, the order matters. We prepare income statement first. Using income statement, we prepare retained earnings statement. Using income statement and retained statements, we prepare balance sheet. Using all these 3, we prepare cash flow statements. So 2 of our financial statements are income statement and balance sheet. Again, if you remember, we had 5 groups of accounts, right? Assets, liabilities, equities. These 3 will be reported on our balance sheet. Hey, take a look. Isn't it our accounting equation? Yes, it is. So balance sheet basically is our accounting equation. It means why it is called balance sheet, because the left side should be equal to the right side all the time. The total amount under the asset section should be equal to the summation of the total amounts on the right section of our liabilities and equities. So 3 accounts are reported, 3 account groups are reported. Now let's see where we can find the other 2 account groups. Revenues and expenses will be reported in our income statement report. Revenues go first and then expenses will be deducted. Remember, in accounting, when we put pair of parentheses around the number, it means we are deducting that number from the number above it. So basically, this is like revenue minus expenses equal net income. So we learned something new here. Net income or loss is basically the result of deducting expenses from revenue. The formula is revenue minus expenses equals net income or loss. Net income or loss is the output of our income statement. It is important because we are going to use this number somewhere else. As you can see here, this is an example of an income statement. On top of the slide, we report our revenues here, and then we report our expenses. Total expenses are reported here. Why there are 2 columns? The second column usually is the aggregated number. As you can see here, the summation of these numbers equal 1950. So if an item like expenses, if an item has components, those components will be reported in the first column, and then their summation will go to the second column. Service revenue has no component, so it directly jumps into the second column. That is how we report in our financial statements. But regardless, so we have revenue reported here, the summation of expenses reported here. But I think I'm going to correct this statement by putting parentheses around expenses. It is missed. 4,700 minus 1,950 equals 2,750. It is called net income, the output of our income statement. Don't worry about the components, the elements inside the expenses. We will learn them in the future. For now, all we need to know is that our total expense and our total revenue are this much. So we take the output of our income statement, 2,750, and we put it into our retained earnings statement. See why we prepare income statement first and retained earnings statement later? Because retained earnings statement depends on the output of income statement. So we put the net income into the first line of the retained earnings statement, and we go further. We will talk about the components of in this statement later, but the point is that the output of retained earnings statement is called ending retained earnings. Ending retained earnings. Again, we use this number, the output, and as you can see here, it goes to another statement. What's that statement? Our balance sheet. So retained earnings statement goes to the balance sheet. Balance sheet, as you know, reports our assets as well as our liabilities and equities. Assets equal liabilities plus equities. We can present our balance sheet in a horizontal format like this. Assets go to the left, liabilities and equities one on top of the other on the right, or we can present them vertically like assets and then liabilities and then equities, all one after the other one. The bottom line is that financial statements are interrelated. They depend on each other. You cannot prepare them individually except for income statement. So we talked about these statements technically, but conceptually we didn't talk about them. Income statement shows the profitability of our company, how much money we are making. Are we making good amount of money? Are we losing our money? How we are performing. At this point, you know that we list our revenues first and then we deduct our expenses. The result is called net income. Income statement does not include dividends. Remember, dividend is not an expense. That is important. Dividend is not an expense. Dividend is investors' money. We are basically giving our investors their own money. Expense is a payment that is consumed, that is used. Sometimes income statement is called statement of operations. In your homework assignments, most of the companies, as you have noticed, they don't call their income statement. Most of them call it statement of operations. It's also sometimes called P&L, profit and loss statement. Retained earnings statement shows the amount of earnings that is kept inside the company, shows the amount of money that is kept inside the company, just like income statement. I missed that. Just like income statement here, we are reporting our numbers over a specific period of time. Income statement as well as retained earnings statement. We are reporting our number over a specific period of time. For example, from January to December, how much money did we make? We do have one statement which doesn't represent a period of time. It shows a point in time, one single date of information. Back to retained earnings statement. Retained earnings statement shows why and how our earnings, overall earnings, are increased or decreased. It is balance sheet, that is statement I told you, which shows our data at a specific date in one specific point in time. It is not about a period of time. We don't know about January when we look at the balance sheet. We don't know about January. We have no idea. If balance sheet is prepared at the end of the year, all the data shows the ending balance at the end of the year. That balance, those balances could be more or less than January's balances or like June balances. We don't know. We have no idea. Balance sheet represents a specific date, which is usually end of the year. It is also sometimes called a snapshot of the company's financial condition at a specific moment in time. And finally, the last statement is a statement of cash flows. Again, you will learn more about this statement in your future classes, but basically it just shows how much money you received, how much money you paid. Not all revenues are collected in cash. Receipts are everything in cash. Payments are everything in cash. Revenues and expenses could be in cash, could not be in cash. We will learn more about this subject in chapter 3. But for now, just remember that cash flow statement shows how much cash was added to and how much cash was deducted from your business.